stop what you're doing. A critical financial tremor just went almost unnoticed. BlackRock's $26 billion corporate lending fund was hit with $1.2 billion in redemption requests. For the first time ever, it was forced to trigger its emergency brake, paying out only its 5% quarterly limit. Around $620 million storta. This is not an isolated event. It is the first public fracture in the paper financial system. What the market is missing is that this credit event is the catalyst directly connecting to two other silent historic thresholds just crossed in the physical silver market. In this analysis, we will connect these three signals, following the data, to reveal how this private credit crisis is the trigger for a far larger reckoning in physical assets. But to understand the scale of this, we have to look past the symptom, the credit freeze, and diagnose the disease. That diagnosis begins with the hard inventory numbers from the heart of the paper market itself, the COMEX vaults. On March 6, 2026, for the first time in its modern data history, a hard line was crossed. COMEX registered silver, the metal explicitly tagged as deliverable against futures, slipped under the 80 million ounce mark, printing at 79,288,594 ounces. For the integrity of the paper market at current terms, registered is the key category. It is the metal the exchange has actually committed to make available for delivery. Eligible metal sits in the same vaults, but it is simply stored there for private owners. Think of a car dealership. Registered silver is the new cars on the lot, with price stickers. Eligible is more like customers' cars parked in the dealer's secure garage. Same building, different inventory. Those parked cars are not on the dealer's books, and neither is eligible counted as deliverable inventory. Mechanically, eligible can be reclassified into registered, but only if the owner chooses to, usually because price or contract terms improve. None of that metal is obligated to move, which is why it cannot be treated as a guaranteed backstop for current paper claims. And owners paying for professional vaulting and insurance are not the natural first sellers at today's prices just to rescue over-levered shorts. March 6th showed what happens when the for-sale lot gets hit in size. That sub-80 million print was not a bookkeeping tweak. It came from an outright physical draw of 145,939 ounces out of registered in a single session. That is more than 2% of all registered silver gone in one day. Across the entire COMEX complex, 2,557,923 ounces left the system that same day. Crucially, this did not come from one vault. The CME's own daily report shows simultaneous outflows from 5 major facilities: Asahi, Brinks, CNT, MTB, and StoneX. These vaults are run by different operators serving different client bases. When all of them are bleeding metal on the same day, you are not looking at one bank shuffling bars internally. You are seeing a broad pattern of owners choosing to pull silver out of the exchange system altogether. Zoom out over the last 5 months and the pattern is even starker. Total COMEX silver inventory has fallen about 35%, from roughly 532 million ounces down to around 346 million, a net loss of about 186 million ounces. The registered slice, the metal that actually stands between paper promises and failed deliveries, has been hit harder still. From its 2020 peak, registered has been cut by roughly 2/3, a 6.7% collapse, from on the order of 240 million ounces to today's sub-80 million reading. These numbers come straight from the CME Group's own reports, and the pace of drawdown has clearly accelerated into early 2026. This physical reality is now on a mathematical collision course with the paper claims stacked against it. For the upcoming May 2026 silver contract, open interest represents 34.7 million ounces of paper silver claims. Against that sits an estimated 73.6 million ounces of registered metal actually available for delivery for that month, creating a paper-to-physical leverage ratio of 5.2 to 1. Put differently, for every ounce of real, deliverable silver in the for sale bucket, there are just over 5 ounces promised on paper. Treat that ratio as a simple stress test, and the imbalance becomes very clear. If 20% of longs on that May contract insist on taking delivery rather than rolling, they would be asking for about 76.9 million ounces, 0.20 times 384.7 million, against 73.6 million ounces of registered. You are already short by more than 3 million ounces before you factor in any new demand or further withdrawals. I am not saying 20% is the base case. It is a conservative scenario to show how little margin for error is left. To keep the system comfortable, a clear majority of contract holders must either roll their positions forward or accept settlement without taking metal, and the leverage itself is fragile. Hold open interest constant and ask what happens if registered slips by just another 10 million ounces, from 73.6 down to roughly 63.6 million. The paper-to-physical ratio jumps above 6 to 1. At these inventory levels, relatively small additional outflows translate into large increases in leverage, and any spike in delivery demand forces the exchange and its participants to scramble for new metal at higher prices or to lean hard against physical delivery. That is the first clear signal of the squeeze, a quantifiable, verifiable, and accelerating drain at the very heart of the New York price-setting mechanism. Registered silver is being pulled out of COMEX faster than it is being replaced, while the stack of paper claims resting on that shrinking base remains enormous. For all its flaws, COMEX is still relatively transparent. We can see this stress building in the exchange's own vault reports. The second signal of the squeeze comes from a place far more opaque and far larger in scale, the vaults of the London Bullion Market Association. And what the quiet data points from London are suggesting is that the problem we can measure in New York is only the visible tip of a much larger systemic iceberg. That systemic iceberg is a single devastating number. A ratio. The second signal of the squeeze comes from the global hub for physical clearing, London. The LBMA's own February 2026 vault report shows 9,210 tons of gold and 65 tons of silver. That's a silver to gold inventory ratio of just 2:4 to 1. For every ounce of gold in institutional storage, there are now fewer than 3 ounces of silver backing the system. Keep that 2/94 in mind when you look at the screen price. Gold trades at roughly 60 times the price of silver. The price says 61. The vaults say 3:1. Those two ratios describe the same metals, but imply opposite things about which one is scarce. Geology gives us a third benchmark. The Earth's crust yields about 7.8 ounces of silver for every 1 ounce of gold mined, roughly 8 to 1. Yet London shows only 294.1, about 62% below the geological ratio. On its own, that doesn't tell us exactly where the silver went, but it does show that accessible silver inventories have been drawn down much harder than gold's relative to mine supply. The Silver Institute's data fills in the missing step. They record structural market deficits for 5 consecutive years, including a 148 million ounce shortfall in 2024 alone. In each of those years, total supply, mine output plus recycling, failed to meet total demand. The gap had to be filled by selling down existing above-ground stocks, precisely the kind of metal held in clearing hubs like London. Picture two water tanks labeled gold and silver. For every gallon nature pours into the gold tank, it pours almost 8 into the silver tank. Yet when you open the hatch at the LBMA, you don't see 8 to 1, you see barely 3 to 1. The only way that picture makes sense is if the silver tank has a much larger, constantly open drain than the gold tank, and that drain is industrial offtake. Solar, EVs, and electronics all use silver as a critical industrial input. Once those grams are soldered into circuits or laminated into panels, most are so dispersed and low grade that at current prices and technology, they're uneconomic to recover. The metal still exists, but for the bullion system, and on any realistic investment horizon, it is effectively removed from circulating inventory. That is what the Silver Institute's structural deficit really describes. Year after year, industrial and investment demand pull more silver out of accessible storage than mines and recycling put back in. So line up the three numbers, a 60.1 price ratio, an 8.1 geological flow, and a 2.94.1 London vault stock. The financial narrative says gold is rare and silver plentiful. The physical data from the world's main clearinghouse says the opposite is emerging. Silver, relative to gold, is already the tighter market. That disconnect is the core of the historic lie around silver's supposed abundance. London matters because it is where institutional bullion obligations are netted and settled. When its silver to gold ratio compresses this far, the buffer that supports paper claims and leveraged trading becomes thin. The vaults in London, and as we saw earlier in New York, now carry a dense stack of paper promises on top of a shrinking base of readily deliverable metal. Structural deficits are a slow-motion crisis. They quietly erode that base year after year. They turn fast when something outside the metal market forces a sudden repricing of collateral and a scramble for physical. That something is often stress in the sovereign debt market, where volatility and collateral calls transmit straight into bullion. That shock is no longer hypothetical. The first tremors are already visible. In the next segment, we'll track how that sovereign bond stress can be the spark that finally tests whether the metal in London and New York is really there when it counts. And while the tremors originate in the sovereign debt market, their first visible impact is cracking the weakest part of the financial structure, the multi-trillion-dollar private credit market. This is the spark that ignites the fuse. This is not a future projection, it is happening now. The mechanism is called gating, a sanitized term for when a fund denies or severely limits investors' requests to get their own money back. Look at the hard numbers from March 2026, reported by Reuters and Bloomberg. BlackRock's $26 billion private credit fund received about $1.2 billion in redemption requests in a single quarter. That's roughly 9.3% of the fund's net asset value. But the fund's documented rule is a 5% quarterly payout cap. In other words, investor demand to exit was almost twice the maximum the structure is designed to handle. The fund ended up paying out only around $620 million, just over half of what investors asked for, and for the first time, it officially hit its 5% quarterly gate. Nearly 580 million of redemption requests were effectively pushed into a queue. Investors asked for their money, and the world's largest asset manager told almost half of them, "Not this quarter." This is not an isolated event. The pattern is spreading across the private credit complex. Blackstone's massive BlackRock vehicle had to inject about $400 million of its own capital just to meet redemption demands. A single support check, almost 2/3 the size of what BlackRock's fund actually paid out. Blue Owl Capital took an even more extreme step.
It permanently halted redemptions in one fund and is forcibly liquidating roughly $1.4 billion in assets. That liquidation fire sale is larger than the entire $1.2 billion redemption queue that just strained BlackRock's product. What we're seeing is the cockroach principle applied to finance. When you see one cockroach in your kitchen, you don't celebrate killing it. Your first thought is, how many more are hiding in the walls? BlackRock gating is that first cockroach, and here's the crucial point. A flagship BlackRock fund doesn't gate because it forgot how to manage cash. It gates because the underlying loans are too illiquid to sell quickly at the values they're marked at on the books. The marks only hold as long as redemptions are throttled. If the most sophisticated, system-critical manager in the world has to slow the exits to defend its valuations, then weaker funds holding similar structures are almost certainly sitting on the same basic problem, loans valued as if liquidity is abundant, when in reality it disappears the moment too many investors head for the door. That is what makes this a systemic illiquidity and overvaluation issue, not one mismanaged fund. But stop for a moment. This isn't just a clever analogy. What most analysts are missing is the direct numerical link to the US banking system's $500 billion exposure. If you don't grasp this next detail from the Federal Reserve itself, you're missing the true systemic risk. We can actually put a number on that risk, and the regulators already have. According to the Federal Reserve Bank of Boston, US banks hold roughly $585 billion in total exposure to this opaque private credit and private equity universe. The FDIC's 2025 risk review flags this as a channel for a broader liquidity shock. In plain language, transmission risk means this. When private credit funds gate and are forced to mark down or dump assets, the damage doesn't stay inside a few products on a platform. It hits bank balance sheets through direct loans, credit lines, and structured exposures tied to the same borrowers. Even a mid-single-digit loss rate on 585 billion translates into tens of billions of capital vaporized in a banking system that runs on relatively thin equity buffers. And this isn't coming from fringe commentators. Steve Eisman of The Big Short fame has already labeled private credit a slowly unfolding scandal. This is where the behavior shifts. When sophisticated investors put in a redemption request and a BlackRock or a Blackstone fund comes back with, "You can't get all your cash," they don't treat that as a one-off annoyance. They widen the lens. They start cutting exposure to similar vehicles, they tighten their risk limits, and they begin asking the same question many of you quietly ask. Is the asset actually there when it counts? Or is it just another paper promise that only works as long as nobody really tests it? The rational response is to move part of your wealth out of structures that can gate you, reprice you, or rehypothecate you, and into assets you can physically hold and directly control. Assets whose value does not depend on a fund committee approving your redemption request. For our purposes, the clearest example is physical silver, a real metal in your possession with no counterparty between you and the underlying value, in a market where we've already seen how dangerously thin the vaulted inventories have become. So at this point, we've established the two critical components. First, the critically low physical inventory sitting in COMEX and LBMA vaults. Second, a live unfolding crisis of confidence in paper credit claims, visible in hard gating data and regulator warnings. The next logical step is to connect these two threads. In the next chapter, we'll map out exactly how this private credit catalyst collides with the fragile silver supply structure to create the conditions for a full-scale price reset. These three signals, the COMEX vault drain,
the LBMA silver versus gold inventory ratio break, and the private credit gating are not separate stories. They are three parts of a single mechanism, reaching its terminal phase. We need to connect these dots with precision. First, the catalyst, the private credit crisis. When funds at names like BlackRock start gating redemptions, investors are being told that a paper promise can be suspended. A leads to B. Funds gate. Trust dies. Once you are refused your own cash, you reprice the risk of every other paper claim you hold. Second, the reaction. As counterparty risk becomes undeniable, capital's objective flips from yield to survival. The priority is no longer a few extra basis points, but removing the chance that someone else can say, you can't have it. So it leaves promise-based structures and moves into real, no counterparty risk assets, especially metals in direct physical form. Third, and most critical, is the collision. This wave of fear-driven capital heads for its traditional safe havens, the COMEX and LBMA silver markets. But the data already showed those reservoirs are thin. On COMEX, open interest represents about 5.2 paper claims for every ounce of registered silver. In London, the ratio of silver ounces to gold ounces in LBMA vaults is at record lows. Together, the COMEX drain and the LBMA inventory ratio break tell you the tank is almost dry before the stampede even begins. Now put the chain together. A. Credit funds gate. B. Trust in paper claims collapses. C. Capital flees paper and demands real deliverable metal. D. That tidal wave of orders hits a COMEX LBMA complex that cannot meet it at current prices. E. Silver is repriced higher to ration scarce physical, and this collision is visible wherever the market must deliver real metal. In Shanghai, a market that prioritizes physical silver, prices have traded at premiums as high as $13 over the COMEX paper price. That is evidence of this mechanism. The arbitrage link between Western paper and Eastern physical has broken, and the East is paying the scarcity price that drained Western vaults try to deny. This is the formula for a squeeze. A systemic financial shock forces a scramble for safety, but the traditional physical shelters, COMEX and LBMA silver, are near empty. Fear collides with scarcity, and the pressure vents through a reset in the price of real ounces versus paper claims. Now that we've connected these three pillars, the vault drain, the credit crisis, and the unstoppable industrial demand we'll cover next. Which one is most alarming to you? Drop one word in the comments: drain, credit, or industry. Because this equation, this collision between fear and empty inventories, is about to be amplified by one more factor. A system-critical source of demand that doesn't care about price and cannot be deferred. That's where we go next. That source of demand is relentless, inelastic industrial consumption. While investment demand grabs headlines, the Silver Institute's data show that industrial and other users have quietly pushed the market into its fifth consecutive structural deficit. 2024 alone saw a 148.9 million ounce shortfall, just over 2 months of global mine output. From 2021 through 2024, the cumulative deficit reached about 678 million ounces, nearly 10 months of global mine production. A large portion of that metal is no longer sitting in vaults. It is dispersed across long-lived industrial and energy infrastructure where recovery is technically difficult and uneconomic at today's prices, making it effectively removed from available bullion inventory. In 2024, industrial fabrication hit a record 680.5 million ounces, 59% of all silver demand. That record comes at the end of 5 straight years of structural deficit. Industrial pull has stayed strong even while the market repeatedly consumed more metal than it produced.
This is the critical point of divergence. Investment demand is inherently price sensitive. If the price triples, some investors will take profits or step aside. Industrial demand behaves differently. At a 59% share, it is the baseline of the market. Roughly 680 million ounces a year that factories, utilities, and OEMs need simply to keep production lines and infrastructure plans on track. Using the Silver Institute's own ratios, that industrial base alone now absorbs about 4/5 of annual global mine output before a single bar, coin, or ETF share exists. The 678 million ounce cumulative deficit is what happens when that baseline pool, layered on top of all other uses, repeatedly exceeds what miners and recyclers can deliver. Investor flows adjust around that constraint, they don't remove it. To see why this industrial base is so insensitive to price, look at cost share. In most of silver's key applications, the metal is a tiny slice of the finished product's cost, but it is functionally non-substitutable. And the sectors that use it most, solar, EVs, high-end electronics, are being driven by multi-year policy mandates and corporate roadmaps, not short-term speculation. Take a simple solar example. Imagine a module that sells for $200 with $10 of silver at today's prices. If silver triples, that line item becomes $30 and the panel price rises to $220. A 10% move at the module level. But panels are only part of a project's cost. Once you add land, racking, inverters, labor, permitting, and financing, that 10% panel move shrinks to a low single-digit change in the fully installed cost per watt. Developers under long-dated clean energy contracts don't cancel 20-year power purchase agreements over a few % change in capex. Now, a stylized EV. Suppose an electric vehicle sells for $40,000 and contains $50 worth of silver in its wiring, sensors, power electronics, and charging hardware. Tripling silver pushes that content cost to $150, taking the sticker price from $40,000 to $4,000, about a 0.25% change. No OEM is going to halt an EV platform or miss fleet electrification targets to avoid a 0.25% cost increase tied to a component it cannot remove. The same logic scales to high-end computing and AI data centers. Whether it's a $5,000 server blade or a $500 million facility, silver content is measured in tens of dollars per server against thousands in chips, cooling, real estate, and software. Tripling the silver price barely moves the overall project budget. Cutting off that silver input would halt production entirely. These scenarios are stylized, but they capture the core point. Silver is a mission-critical technical input whose cost share is so small that even large percentage price moves barely register in end product economics. What this creates is a dual demand collision. On one side, you have a roughly 680 million ounce industrial base that must be fed every year. A base that already absorbs about 4/5 of new mine supply. On the other side, you have everything else. Jewelry, silverware, photography, and crucially, coins, bars, and ETFs. Based on the 59% industrial share, non-industrial uses collectively demand on the order of 470 million ounces a year at today's levels. Yet after industrial users take their slice, less than 130 million ounces of annual mine output remain available for all of those other categories. The only way the books balance is by tapping recycling and above-ground inventories. And the Silver Institute's own deficit numbers tell you that even that hasn't been enough. 2024 still ended 148.9 million ounces short. When Safe Haven Capital surges into the market, it is trying to acquire metal from the same constrained pool that every other non-industrial user is drawing from. That is the collision. Two powerful, fundamentally different sources of demand, competing for a shrinking slice of physically deliverable silver. And this supply-demand structure now shows up explicitly in US policy. In February 2026, the US Geological Survey added silver to its draft critical minerals list for the first time, citing its non-substitutable role in clean energy applications and the EV supply chain. That list is for materials that are both essential to economic or national security and exposed to potential supply disruption. Exactly the combination the deficit and industrial demand data describe. Being on that list puts silver in the same strategic bucket as lithium, cobalt, and rare earth metals, and requires federal agencies to factor silver's supply risk into resource assessments, infrastructure planning, and efforts to secure supply chains. Fine, you might say, the demand is clearly real. But if prices rise, won't miners just produce more to meet it? That is how commodity markets are supposed to work. Higher prices incentivize more supply, the deficit closes, and the system resets. But what if the fundamental geology and economics of silver mining make that response almost impossible? What if even dramatically higher prices cannot conjure a meaningful new wave of mine supply into existence? Understanding that is the key to why this isn't a typical market cycle, but a structural endgame for the silver market. And that's where we go next. The answer to why higher prices can't fix this lies in a simple, non-negotiable fact of geology and economics. Most silver isn't mined for itself. That single constraint drives a set of second-order effects that lock in today's physical tightness for years, if not decades, and progressively disable the market's usual corrective mechanisms. Let's connect the mechanics. First, mining supply simply cannot respond quickly to a silver price signal. Silver Institute data for 2024 shows that roughly 72% of all mined silver came out of the ground as a byproduct of copper, lead, and zinc. That means, in practice, only about 28% of mine supply even has a chance of responding directly to a higher silver price, roughly 3 ounces out of 10. The rest is chained to whatever is happening in the base metal cycle. You can't just decide to mine more silver. You would first have to justify major new copper or zinc projects on their own economics. And when those industrial metals roll over in a slowdown or recession, the mining companies don't check the silver price before cutting output. They simply scale back copper and zinc. And with that decision, more than 70% of global silver production automatically shrinks, even if silver itself is screaming higher. Even on the small slice of primary silver projects that could respond, the timeline is glacial. Industry reports put the average lead time from discovery to full production at about 7 to 15 years. A price spike today, in other words, does not deliver meaningful new ounces into the system this year, next year, or even 5 years out. It shows up, if at all, near the back end of that 7 to 15 year window. Now put that beside the structural deficit we quantified earlier. That multi-100 million ounce gap between what the world uses and what mines actually produce each year. Barely a quarter of mine supply is even theoretically price responsive, and any new primary capacity that might close that gap sits a decade away on the project timeline while the deficit compounds annually. That is the throttle effect the geology has built into this market. There is no quick supply relief valve. Second, when that kind of inelastic supply collides with relentless policy-driven demand, you don't just get a higher price, you get a split market. The paper price you see on a quote screen is the clearing level for leveraged claims and cash-settled contracts. The physical price is what it actually costs, all in, to get real metal delivered into the right jurisdiction and into your hand. In a normal commodity, arbitrage keeps those two tightly aligned. Buy the cheap paper, stand for delivery, move the metal, sell into the premium, and pocket the spread. But that mechanism depends on two things we no longer have in silver: ample deliverable inventory in the major vaults, and a willingness by large players to actually push contracts to physical delivery instead of rolling or taking cash settlement. We already saw in earlier chapters that COMEX and LBMA deliverable stocks sit at historically thin levels relative to outstanding paper claims. That means you simply cannot scale up delivery enough to close a large, persistent physical premium everywhere it appears. The first few players through the door may get bars. Everyone behind them is left with a cash adjustment and a paper mark-to-market. That's exactly what the Shanghai market has been signaling. Sustained physical premiums of over $10 an ounce for extended periods, not just a one-day spike, on a metal whose benchmark price is quoted in tens of dollars per ounce. A $10 add-on is a very large double-digit percentage gap between paper and delivered metal. And that gap has proven sticky. Yes, as long as there is some metal, traders will try to nibble at that spread. But when the quantity of metal that can actually move is dwarfed by the volume of paper claims, arbitrage doesn't eliminate the premium. It just drains what little inventory remains and reinforces the perception that paper is a claim that may not be fulfilled in size. That is how you get a persistent, structurally wide physical premium, a bifurcation where the paper quote becomes more of a reference number than a true clearing price for real ounces. Once that bifurcation is visible, the next stage isn't academic. It's policy. When governments see that key industries are bidding against financial players for scarce physical, and that exchange prices no longer guarantee prompt delivery, they stop trusting the open market to take care of supply. Finally, that's where you get government action. As nations internalize that their green energy build-out and critical defense supply chains are directly constrained by silver availability, they move to secure their own access. The United States and the European Union have already taken the first formal step by classifying silver as a critical raw material in their own frameworks. In the language of those reports, critical is not a label for marketing. It's a signal for policies to secure supply, diversifying sourcing, locking in long-term offtake, and, where necessary, building strategic inventories. We've already run the numbers together. Industrial uses dominate silver demand, and fast-growing segments like solar photovoltaics, EVs, and advanced electronics account for a meaningful and rising share of annual consumption. Every additional gigawatt of solar or tranche of military electronics locks in incremental silver demand that cannot easily be substituted away. For a policymaker, that combination, critical sectors plus inelastic supply, makes strategic stockpiling and direct offtake agreements a rational response, not an optional extra. Once those state-level buyers start accumulating, they do not trade in and out like a hedge fund. Their mandate is to hold. That hoarding behavior removes additional metal from the free-floating pool and pushes the burden of adjustment back onto the remaining market. Put those pieces together, and you finally have an actual loop, not just three separate pressures. Tight, largely inelastic byproduct supply creates chronic shortfalls and forces up physical premiums in the locations where metal is genuinely needed. Those visible premiums and recurring delivery strains convince sovereigns and large industrials to secure their own stocks outside the open market. Sovereign and strategic stockpiling then pull even more metal out of the tradable system, making the float thinner, the deficits sharper,
and the physical premiums more entrenched, which in turn justifies even more stockpiling. These three forces, inelastic byproduct mining, a bifurcating price structure, and sovereign stockpiling, form a self-reinforcing system. This isn't a temporary squeeze that a few quarters of higher prices will resolve. It is a structural deficit etched into the geology of our planet and the geopolitical priorities of major economies. The market won't fix this in any conventional sense because the fundamental mechanics of supply and delivery are what's broken. And so, when we connect these threads, the conclusion is inescapable. Three independent, data-verified signals all converge on the same stress point in the silver market. First, the COMEX vaults. The supposed bastion of the paper market is being steadily drained of the silver behind its promises. We walked through how open paper claims now tower over the metal in the registered category, multiple paper claims sitting on each registered ounce. The claims per registered ounce ratio we calculated sits at the extreme end of this cycle. Second, the LBMA vaults in London. The data shows silver holdings have been drawn down while gold has held relatively steady, driving the silver to gold vault ratio back toward the lows we highlighted. That is measured inventory level scarcity that today's paper price simply refuses to recognize. And the catalyst, a crisis of confidence. When investors find that supposedly safe private credit vehicles can delay or deny withdrawals, they suddenly see the counterparty risk baked into those promises. That pushes capital toward assets where there is no intermediary between them and their savings, most directly into physical precious metals. That rising monetary demand now meets a market where above-ground inventories are already tight versus annual investment and industrial offtake. We showed how that combined draw now exceeds new mine supply. Industrial users keep pulling metal regardless of price, turning the deficit into a steady drain on the small pool of freely available ounces. As paper claims multiply against that shrinking base, you have the textbook conditions for a forced repricing. That is what the math actually shows. COMEX coverage, LBMA stocks, and real-world demand all pointing the same way, with the confidence shock already in motion. The crisis is delayed. It is not averted. For positioning, the takeaway is simple. Fragility sits in paper claims on metal, not in the metal itself. Accepting volatility to hold fully owned unencumbered ounces is rational when deliverability, not chart patterns, is the core risk. We'll keep tracking COMEX claims versus registered inventory, LBMA vault movements, and the balance of mine supply and industrial demand. Subscribe and turn on notifications if you want those diagnostics before they reach mainstream coverage.